The world doesn't move in straight lines right now. Supply chains are broken. The Middle East is at war. Markets are on edge. And in moments like these, one thing separates the people who build wealth from the people who lose it. Psychology. Not the market, not the news, your psychology. If you're not prepared for what we're about to walk through, prepared mentally, not just financially, this data will work against you. Markets have always done the same thing. They wipe out the unprepared. Panic buyers on one side, panic sellers on the other. And a very specific class of institutional players quietly building generational wealth from both. That's not new. That's the oldest story in finance. So let's get into the data. No narrative, no hype. Just what's actually happening. Western spot silver is sitting at $82 as we record this. It came off $84, touched $81.90, and it's consolidating. The lower time frames are weak and directionless. We're not going to dress that up. But here's what the paper price isn't telling you. While Western spot trades at $82, Shanghai Futures Exchange closed at $96. Shanghai spot price, $94. That's a $12 premium. And it's not closing. This is not a glitch. This is a signal. The Shanghai Futures Exchange shed 22 metric tons of silver in a single session on Thursday, 710,000 ounces, pulled from SHFE vaults in 24 hours. Total SHFE silver inventory now stands at 8.76 million ounces. Silver closed on the SHFE at 97.54, up nearly 2% on the session. Gold closed at 5,192. Platinum at 2,543. Palladium slightly down at 1,929. But the Shanghai Gold Exchange data, this is where it gets serious. February SGE withdrawals, 115 metric tons of physical silver in 1 month. The 8-year seasonal average for February is 62 tons. We saw nearly double the historical norm. And when you combine January and February together, 436 tons of silver withdrawn from SGE vaults. A record high for that period in the entire history of the dataset, more than double the same window last year. The SGE vaults also shed 13,155 kilograms in the single week of February 23rd through 27th alone. This isn't demand. This is a scramble. Now layer COMEX on top of that picture. On Tuesday, 3 million ounces drained from COMEX in a single session. Metal exiting Asahi, Brinks, CNT, IDSD, and MTB simultaneously. Hundreds of thousands of additional ounces adjusted out of registered status across 3 more custodians. Registered silver, the metal actually available for delivery, now sits at 87 million ounces, a fresh 1-year low. And COMEX open interest has crashed to 112,874 contracts, the lowest level since 2013. The paper gamblers are walking out, and a casino that loses its players loses its power to set the price. SHFE draining, SGE draining, COMEX draining, East and West, simultaneously. That is not a coincidence. That is a structural story. Physical silver is leaving the system at a rate the paper price is refusing to acknowledge. The stress isn't limited to silver. China's gold market is showing the exact same pattern. 2 of China's Big 4 banks, ICBC and the Agricultural Bank of China, have investment gold bars listed as sold out on their apps right now. The Bank of Communications isn't even offering them anymore. Beijing retail shops are selling branded gold at over 1,600 yuan per gram. While paper gold in Western markets trades around $2,596, the physical market in Asia is pricing something very different. Same signal as silver. Demand outpacing supply. Paper price and physical reality pulling apart. We've covered Jane Street in depth in previous videos. Here's what's new. Their equity position in SLV has grown to approximately $1.66 billion. But sitting on top of that, call options on nearly 40 million underlying SLV shares, $2.5 billion. Put options on 43 million shares, $2.7 billion. Their options book alone exceeds $5 billion, more than 3 times the equity stake. This is not a firm that bought SLV because they think silver goes up. The underlying position is the tool. The options book is where the money gets made. Here's why the pattern matters. Implied volatility doubled from the October highs, while price was simultaneously rising. Rising prices should compress fear, not amplify it. But we saw rising price, rising short interest, collapsing borrow costs, and exploding implied volatility, all at once. That combination does not happen in a clean market. The custodian of SLV through all of this is JP Morgan, the same institution that paid $920 million in 2020 to settle 8 years of precious metals spoofing charges. Settled federal case, not a theory. The structure hasn't changed. It has only grown. The Trump administration has brokered a deal to import up to 1,000 kilograms of gold from Venezuela's state-owned mining company, Minervan. Trafigura is shepherding the metal to U.S. refineries under a separate government arrangement. The contract calls for 98% final gold content. Value: potentially over $150 million. 1 metric ton. The first ton is already moving. And here's the pattern forming. In a world fracturing into geopolitical trade blocs, metals are being redirected along political alliances, not open markets. A country sitting on hard assets, gold that has held value for thousands of years, is trading it for paper dollars that keep getting debased. If gold flows along political lines, watch Mexican silver. It sits in the same strategic geography. Watch that space closely. The governor of the National Bank of Poland has proposed selling a portion of Poland's 550-ton gold reserve. The potential yield: approximately $13 billion, to fund defense spending. There are legal barriers. The Prime Minister backs an alternative EU route. This is not a certainty. But the moment it hit the wire, precious metals sold off. That tells you everything about where market sensitivity is right now. Even the word proposal is enough to trigger a sell-off in metals. Your position sizing has to account for geopolitical surprises that have nothing to do with fundamentals. That is the environment we're operating in. WTI oil is trading above $78 as we record this, the highest level since January 2025. Up roughly 35 to 40% from December lows. But the energy picture is where this gets genuinely dangerous. Iranian forces have already struck key regional energy infrastructure in recent days. Senior officials have publicly named $200 per barrel as the likely consequence if conflict escalates further. That is not a war game scenario. That is a named threat from a named adversary that has already demonstrated willingness to act. The Strait of Hormuz still carries roughly 20% of global oil consumption and a similar share of LNG trade. Map the inflation math. A sustained move to $180 per barrel adds approximately 0.5 to 1% to Eurozone headline inflation. At $200, we are looking at the onset of a second major inflation wave, before the first wave has even been fully tamed. Layer this on top. Qatar's LNG facility is offline following regional strikes. Restarts are potentially weeks away. Coal futures surged over 8% in a single session as markets pivoted to fuel switching. And Putin has publicly floated rerouting Russian pipeline gas entirely away from Europe. Oil, LNG, pipeline gas, coal alternatives, all under simultaneous pressure. This is not one risk. This is a stack. Korea's Kospi surged 9.6% today in a sharp rebound after a historic sell-off. But zoom out. DAX down 2.5%, S&P down, NASDAQ down, Bitcoin down. Risk assets are broadly selling off while physical metal is draining globally and energy infrastructure is under genuine threat. The market is not pricing optimism right now. It is pricing stress. U.S. initial jobless claims came in at 213,000, against an estimate of 215,000. Continuing claims, 1,868,000, against an estimate of 1,845,000. Slightly better than expected on initials, worse than expected on continuing. The reaction was immediate. The dollar caught a bid. Paper silver dropped from $83 to $81.90. Nothing changed in the physical market with that number. The vault drain didn't stop. The Shanghai premium didn't shrink. The paper market priced the dollar first, and physical reality second. That is the disconnect. And that is the environment you're operating in right now. People expect straight lines. They buy silver at $80, see it hit $86, and panic when it pulls back to $82. That pullback is not a verdict on your intelligence. It is noise. Then there's FOMO. Silver runs from $80 to $86. Now everyone who missed the move needs to buy at $86. No entry logic. No exit plan. Just the emotional need to not be left behind. When the pullback comes, and it always comes, they freeze, or they add. Both are wrong. Both are emotion, not analysis. And the one that costs the most, people who think a thesis is a trade. Silver is going higher is not a trade. A trade has 5 things defined before you enter. An entry. An exit if wrong. An exit if right. A time horizon. And a position size you can sleep with. Without all 5, you are not trading. You are reacting. And this market will find that the second you are in the position. Right now, the short-term tape is weak. The dollar is getting bids. Tomorrow is non-farm payrolls. High impact. Dollar correlated. Capable of moving metals sharply in either direction. Here's the binary. If DXY gets follow-through after NFP and closes above the January 15th level, expect more short-term downside pressure on paper metals. If it fails to hold that level, the picture changes. Either way, patience is the edge. These are real risks. Build them into your sizing. Silver pulled back from $84. The momentum isn't clean. Poland's proposal is a supply signal the market is taking seriously, even as a maybe. Dollar strengthening on data that isn't catastrophic. COMEX open interest at decade lows. Could be weak hands flushed or structural participation leaving. In a real liquidity event, everything sells regardless of fundamentals. These are not hypotheticals. They are live risks. But none of that changes what the physical market is doing. 22 metric tons out of SHFE in one session. 436 tons out of SGE in 2 months. A record. 3 million ounces out of COMEX on Tuesday across 6 custodians simultaneously. China's largest banks sold out of physical gold. A $12 Shanghai premium that held through the paper sell-off. Those are not opinions. Verify every single one yourself. Watch NFP tomorrow. Watch whether DXY closes above or below the January 15th level. Those are the 2 variables that decide short-term direction on paper. The physical drain is the long-term signal. The paper price is the noise. The one question we're leaving open: if NFP pushes the dollar higher and paper metals see more pressure, does the physical drain rate accelerate in response? Because that is the scenario that forces this disconnect into the open, in a way that cannot be quietly managed. Invest with logic, not hype. Market Crux, signing off.